Okay, let's go.
Welcome to The Explainer. We're all about breaking down big ideas. And today, we are tackling a huge one. We're going to uncover the hidden force that's really pulling the strings in the financial markets. And that force is liquidity. So, you've stared at those charts, right? Price zipping up, then crashing down. It can look totally random. But what if I told you it's not random at all? That there's this underlying logic, this powerful magnet that's pulling price around the screen.
Okay, so let's get right into it. What exactly is market liquidity? It sounds complicated, but the idea is actually pretty simple, and it's the engine behind some of the biggest moves you'll ever see.
All right, so what are we talking about here? At its core, liquidity is just a big pile of buy and sell orders waiting to get filled. Think about it like this. Imagine you need to sell, say, 1,000 iPhones right now. You're not just going to stand on some quiet street corner, right? No way. You're going to go to a huge, busy marketplace where you know there are tons of buyers. That place, that's liquid. It's got the pool of money ready to go.
Okay, so let's bring that back to the charts. In the market, the price is basically that seller with the iPhones. It's not just wandering around aimlessly. It is actively hunting for those busy marketplaces, those big pools of orders, so that huge transactions can happen in a flash.
And this is the key. Price has a goal. It moves to one of these liquidity zones. It fills up on all the orders waiting there, and then, well, it's satisfied. And what happens when it's satisfied? That's when you often see those super sharp reversals. The job is done, and it's time to go the other way.
All right, so if price is always on the hunt for this stuff, the big question is, where does it hide? Where is this money on the chart? Well, the good news is it's not random. It actually pools in some really predictable spots.
You see, liquidity loves to hang out in the most obvious places, right above old highs and right below old lows. Think about it. These are the exact spots where tons of traders are putting their orders, so they naturally become these big pools of money.
Okay, let's look at a real example here on the NAS 100. You see this really obvious high point? Well, a ton of traders see that same peak, and they all put their sell orders just a little bit above it. So what happens? You get this huge, dense pool of sell-side liquidity just sitting there, waiting.
And then, check this out. Look what price does. It shoots right up to that zone. See that long wick? It's like a little probe that goes up and grabs all that liquidity. And once it's got what it came for, boom, it reverses, and hard. And it works the exact same way on the flip side. Here we see an obvious old low, and sure enough, price dives right down below it. That long wick is price tapping into that waiting pool of buy orders. It gets its fill, and, you guessed it, it reverses and heads right back up.
Okay, this is where it gets really, really interesting. What are these pools actually made of? It's not just random magic. It's basically two main types of orders working together.
So you've got two groups of people creating these zones. On one hand, you have stop-loss orders from traders who are already in a trade. On the other hand, you've got entry orders from traders who are waiting for a breakout to jump in. And the key thing is, they all tend to put their orders in the exact same obvious places, right above those highs and below those lows. Okay, let's walk through this slowly, because this is a game changer. Picture an area just below an old low. You've got traders who bought earlier and are sitting in profit. To protect that profit, they place a stop loss. Now, what is a stop loss on a buy trade? It's an order to sell. Now, at that very same price level, you have a whole other group of traders waiting to short the market if it breaks down. And what's their entry order? It's also a sell order. So you see, you've got two totally different motivations, two different groups of traders, all creating this giant cluster of sell orders in the exact same spot. And that's the whole point. All these hidden orders, the stop losses and the breakout entries, they create this incredibly powerful magnet for price. The big players in the market, they know where these huge clusters of orders are, and you better believe price is going to be drawn right to them to trigger them.
So we know where price wants to go, to those liquidity pools. But now let's talk about how it gets there. And the best way to think about it is like a river. It's always going to take the path of least resistance.
When you look at a chart, you'll see two kinds of journeys price takes. The first is a high resistance path. It's choppy, it's grindy, it's slow. Price has to fight its way through a bunch of old price levels. But then you have the low resistance path. And that's like an open highway. It's a smooth, fast, straight shot move because there's pretty much nothing in its way to slow it down.
And get this, this is such a key insight. When you see one of those beautiful, smooth moves up, remember that an open highway goes both ways. Since there was nothing to slow price down on the way up, there's absolutely nothing to stop it from coming down just as fast on the way back. That's where you get those absolutely brutal, fast drops.
Okay, so let's tie all of this together. Let's build a whole new way of looking at the market. This is about completely shifting your perspective.
From now on, I want you to try something. Stop looking at a chart and seeing just patterns, head and shoulders, flags, all that stuff. Instead, I want you to see the market for what it really is, a nonstop hunt for liquidity.
And you can start doing this right now. It's a simple 4-step process. 1. Spot the obvious old highs and lows on your chart. 2. See them for what they are, potential liquidity pools, magnets. 3. Just watch. Observe how price acts when it gets near them. And 4, ask yourself, how is it getting there? Is it a slow, choppy grind or a fast, smooth ride?
Look, if you take away only 3 things from all this, let it be these. First, price is not random. It's hunting for orders. Second, those old highs and lows, they're the treasure map. They're the magnets. And third, a smooth ride up often means a fast elevator down.
So from now on, every time you pull up a chart, I want you to ask yourself one simple question. Before you do anything else, just ask, where's the money? Where's the most obvious pool of orders just waiting? Where do you think price is going to hunt next?